Talked about the share capitalization table. This is just a little section on raising finance. So we talk about this again a bit later as well in one of the sessions, but it's useful here because it kind of puts in perspective what we've just been talking about. I guess the key things are, because it's a negotiation, you've got to kind of hold firm, and you've got to be quite clear as founders how much money you want or need, what flexibility you have, and be realistic, because obviously an investor's not going to put in loads of money in a high-risk venture. You can get money from a lot of different sources, and the more sophisticated those sources, the harder the negotiation, and the more detailed the agreements are going to be, which we'll come to in a second. One of the key things, though, I think, is understanding the mindset of the investor. So, most basically, they are expecting to get a return on their investment. It's different from a loan. When somebody loans you money into the company, that is something that is likely to get paid back first or higher in the queue than a lot of other things, depending how strong the loan agreement is. But certainly, if a bank loans you money, they've usually secured it on something like your house, and they've got quite a strict agreement, and it needs to be paid back certainly before any shareholders get any money. So if the company gets into trouble and there is money left, it will go to people that have loaned first. The downside of a loan, though, from a person loaning, is that the upside is relatively small. It'll be an interest-based loan, so maybe 10% or 5% interest, depending on negotiation and so forth. But the upside of an equity investment is this massive capital growth. It could be 10 times your return. And indeed, that's the mindset of an investor. So an investor putting money in as equity, as shares, is looking for a 10 times or higher return in a few years, 5 to 10 years. And that's because they have obviously got to create a return either for themselves or for their own customers in the VC fund. And in a VC fund, they've often got a time limit. So when they've persuaded people to put money into their fund, they've probably said, we're going to aim to pay you back 20 times or 10 times in 5 years or 10 years. So they've got to push that kind of stipulation onto you, which is, we're only going to invest if we can see high growth and a possibility of getting back in 5 or 10 years before the fund closes. As you can imagine, you don't usually get money without an agreement. So friends and family might just put money in, on a shake of a hand and an expectation that you're going to be reasonable. An angel will certainly have some kind of agreement, depending on their sophistication. And a VC will have all kinds of things, including those that are listed there. So usually what happens when somebody puts money in, they are protected in law to a certain extent. You, as the directors of the company, can't just run off with the money, clearly. They are shareholders' rights. But they're not particularly strong. The company can go bust and the shareholders can lose everything. And as I said, they'll be last in line to get any money back. Employees come first, then loans and so forth. So it's high risk, which means usually the agreements try to mitigate the risk. And there's a whole range of things that can happen. First of all, you usually have two types of agreement, an investment agreement and a shareholders agreement. They're closely related, but one is more about how the money's going to go in and what it's going to be used for. And then the other one is what's going to happen when I'm a shareholder and what extra things am I stipulating beyond the basic rights that I have in your constitution. And just to give you a taste of what these kind of agreements might be, in terms of the shares, some of them are listed there. So a future price floor is effectively saying you're not going to issue shares at a lower price than I've just paid for them without me giving you permission for something like that. So they have a veto right on that. Now you need to worry about that because you may really have to do that. In order to keep the company afloat, you may have to accept at some point in the future some investment at a lower price than someone has paid for shares. It's called a down round. It's not great. It makes the value of the company go down, as you might expect, if you plug it into the Excel spreadsheet. But that's to protect them, particularly if they put in a lot of money, to lose their value. So it's important. Most venture capitalists will invest something called in preference shares. So when you created your company, you'll probably have created what's called ordinary shares. They're quite basic and ordinary, and they follow the constitution and they follow some legal requirements. But preference shares have preferences, and they can be stipulated as much as or as complicated as they want to be in an agreement if you sign that agreement. But a good example of what happens with preference shares is they might get dividends first. So if at some point in the future you're profitable but not greatly profitable and you've decided to pay dividends, the preference shares may get them first and ordinary shares may not get any if there's not enough. So that could be stipulated. So if an investor's put in money, he's expecting to get that return more quickly. Tag-along and drag-along rights are an interesting one. They're related. When you come to sell the company, which we talk about later, what you're doing is selling all the shares to someone. And tag-along is saying, if somebody wants to sell their shares, I can sell the same proportion as well. So if the founder decides to sell 100% of their shares for whatever reason, tag-along means everybody else can tag along, which means that if that person that's buying those shares can't afford all the shares, the deal's off. The reason it's important is you want tag along often as well, is you don't want to be left as the only one in the company when there's an exit, because you've got 5% and the people that are buying it don't care that you've only got 5%. Okay, so tag along is important. Drag along is the opposite, where you drag the others. So you've got a great deal, and the two founders, for example, have a great deal that they've negotiated, and all the investors say, oh, we don't want to go yet. We think there's even more money to be made in the future. A certain clause means that you can drag them along. So they have to sell. So nobody can veto the deal. Anti-dilution rights. So the question that you asked about, well, would the friend be worried about being diluted? If he was sophisticated enough, he might have said, well, yeah, I'd like anti-dilution rights. And what that means, the best version of that, is that he is allowed to buy shares at the same price as the new investor to maintain his proportion. So that is good in the sense that it means if he's prepared to pay more cash to invest in the company at a later stage, that's a very positive vibe for the whole company. The problem with it is that depending on the dilution that would otherwise occur, it can create problems with these new investors because they're going to get a less proportion overall because somebody else is also maintaining their proportion. What generally happens, though, is if these anti-dilution rights are exercised, it may be that he doesn't have to. He has the option to. It's actually the founders that end up diluting. Somebody has to be diluted. Founders don't usually have anti-dilution rights because if they can afford that, why are they going to raise more money? Yeah. So ultimately, the founders would suffer. Preemption rights are similar in the sense that if you're going out to get more money, the existing shareholders could have a right to put the money in instead. So let's say you want to raise another $1 million and you've got a pretty good investor, as in a pretty big investor already in there. They might say, we're not having another party coming in. We're going to put in the $1 million at the value that you've proposed or that they've potentially agreed to. So they're preempting the deal. And then put and call options are where shares can be sold in particular instances. So a put option is where an investor can insist that their shares are sold at a particular price at some point in the future because they might want to get out of the company. And what you've got to worry about there is who's going to buy those shares and at what price. Could you end up with your competitor buying those shares, for example, or someone you don't get on with? There's other things you can imagine in agreements. Often it'll be stipulations of who is represented on the board, how much money can be spent on particular items, who can sign off, at what point is it a board resolution to do something, at what point is it a shareholder vote to do something. There's all kinds of other levels of agreement. But this is to just give you an example that the devil is in the detail. And when you come to do this, you've really got to understand what can potentially happen. When you're putting this sort of thing together, of course, it costs a fortune with lawyers, and you want to usually avoid that at all costs. And usually VCs who are insisting on all of this say, and by the way, you're paying for the legal agreements. Yeah. So what you actually have to do is keep the costs down usually. So what the mechanism, the best way of doing this is understand as many of these things as you can, write them in a term sheet. So in plain English, you agree them with the investor. You say, look, this is what we mean by tag along. This is what we mean by drag along. Everybody agrees, and then you give the term sheet signed off, basically to say, we're in agreement, turn it into a legal document. And you give that term sheet to a lawyer who then spends a lot less time and money creating an actual document, and hopefully turns it into a document that everybody's pretty much in agreement with. Because you're raising finance, obviously, as a founder, as the entrepreneur, you are usually desperate for money because your company's running out. So the key is to be raising the money in good time so that you still have a runway, that you're not under pressure and running out of money. And also, you have to understand that an investor won't put any money into the company unless they've looked at your accounts and understood your business. That's called due diligence. Unfortunately, by doing that, they can see how quickly you're running out of money. So what often happens is they will delay the process until you're right at the cliff edge where you're going to run out of money, and then they turn the screws and say, it's this deal or nothing. You've got a month to go. So you have to be aware of that, and the best way to do it is make sure you've got the time and talk to more than one investor and have a feeding frenzy where it's the other way around, where it's the investors that are desperate to invest in you and not miss out on the opportunity, the fear of missing out.
Is there any limit on when an investor starts due diligence and when they have to then complete?
Stop. Yeah, it's up to you. And again, the more control you have in the process, the better. So if you can stipulate that,
okay, cool.
Yeah, you can say, look, we're going to do this for 2 months or something, or a month. What you do have to watch, though, is investors actually are wise to this as well, and they usually say, okay, we're interested in investing, we want exclusivity on this round for the next 2 months while we do our due diligence, which means that you're not allowed to get anybody else to come along and have a look as well. So the downside of that is if it falls away, you've now got to start again 2 months further down the line when it's even more desperate. But also, if you get a bad deal, you haven't got a backup to sort of create that competition. So what you want to do is push back and say, no, it's not exclusive. We retain the right to allow others to look at this deal. Obviously, what we're all aiming for is this exit. So the whole point of all of this probably is to sell the company at the end when it's a great big cake and everybody that's in it is going to make some money. So that's what we call the exit. It's either a trade sale where those shares that you all own are sold wholesale as the whole company to another entity. So the acquiring company buys all the shares. So it's that they're a little bit like an investor from the point of view of that table, but they're buying the shares now from the individuals and they're not putting the money into the company. So you're transferring the ownership of the shares. A nice clean exit is where that acquirer buys the 100%, buys everybody out, all at the same price, and everybody gets their £50 a share or whatever. Think about that. We haven't talked in this section about an ESOP, but it might have come up in conversation with people when you talk about this sort of thing. ESOP is an employer share option plan or a share option scheme, and that's effectively where you're incentivizing employees with shares. Then, usually the employees are not well off that can invest and take the risk, but you do want them to have a stake in the company. And there are ways of doing that, both lawfully and tax efficiently, which in effect incentivize people. So what we've talked about is a private company where the shares are not available on the market when we've talked about this raising venture capital and angel finance. So that's a private limited company. The shares are not listed, so nobody is able to just buy and sell them at their own. They have to come to the company and there has to be that negotiation. As a private company, you have to be very careful offering your shares. So you're not allowed to offer your shares just publicly. You can offer them through a negotiation like we've discussed with a sophisticated investor individual with all the caveats about the risk. But you can't put an advert on your website and say, we're offering shares. And you can't put an advert in the newspaper because that's a public offering. And that, again, is in the realms of financial control. And you have to be registered financial advisor and follow the Financial Conduct Authority and so on with that. So You have to be a little bit careful how you advertise the fact that you're raising finance, but a publicly listed company, a PLC, has its shares on the stock market, and you and I can go and buy them. And that is another way of exiting. Is we talked about a trade sale, and again we talk about it in a later session, is that you can float your company on the stock market. It becomes a publicly limited company. Your shares can now be traded, including the ones that you own, again within legal constraints. Okay, and so raising finance, to sort of underline it, it's issuing new shares at a price. So creating new shares in the company and selling them, and along with that, there's lots of terms and conditions.